Alrighty, guys, welcome back to part two of understanding the markets and using if-then logic. And in today's video, we're going to be talking about understanding standard deviation and premium and discount, weekly profiles in IPDA, so these three here. And if you didn't watch part one, I highly recommend you do that because we talk about time, proper market structure, um, just how the markets move, swing highs and lows, draws on liquidity, that sort of deal. So I highly recommend it. But anyways, for part two, we're going to be talking about standard deviation. So what is it? Standard deviation measures how much price typically varies from their average price or mean. In trading, it helps you understand how normal or extreme price move is, which is the key for spotting profit taking opportunities or reversal trades. Okay, so moving on to why standard deviations work. So price changes are often normal. Over short periods like a day or a few hours, price changes in stocks, forex, or other assets often follow a pattern called normal distribution. A bell-shaped curve. This happens because price movements are influenced by many small random factors like trades, manipulations, or market sentiment, which tends to average out into a predictable pattern. So a bell curve rule, about 68% of moves stay within one standard deviation of the average. 95% of the time stays within two standard deviations, and about 99.7 stay within a 3. So when price expands past a two standard deviation, you'll start to get a reversal or a consolidation 95% of the time, just based off of math and statistics of the standard deviation. How do we use them as reversals or profit taking? So if price stays within one standard of its average 68% of the time, it's a normal move. Nothing special, meaning like that's pretty much the range that price is in. That's consolidation phase. So it doesn't matter if it moves inside the range within the one standard deviation because that's how it generates liquidity as well. If it goes beyond or not generates liquidity, but that's how it makes the higher high per se. But if it goes beyond two standard deviations, only 5% chance it's an extreme. The price has to be stretched far from its average and is likely to snap back or start consolidating to create a new average, which is where we profit take. So this right here is what I was just saying. So like if we are accumulating and then we manipulate and then expand very high up, if you take the manipulation leg and draw out your standard deviation, you'll see price most likely will react around -2 to 2.5 standard deviation, expansion back inside the range, or it starts to consolidate. So then what it does, the consolidation based off market profiles is a continuation. So we take the average price here, slingshot up, and then we start accumulating again. That takes the average from down here to slowly back to up here. So then when price wants to continue, it can create another deviation higher without having to reverse all the way back down. So hopefully that made sense. Mean reversion. Price often returns to their average after extreme moves. Standard deviation helps measure a move if it's too far to take action. So that's literally what I was just explaining is after we slingshot up or expand, price is either going to get the V-shaped recovery back. Okay, so that would be a fake out manipulation, what have you. Or price can go up there and then consolidate, creating a new average like I just said. Understanding premium and discount. So when price goes from a low to a high, we draw the Fibonacci to split the move into zones. Above 50% level, halfway of the range, is a premium zone. It's expensive, so we look to sell or take profits. Below 50% is a discount zone. It's cheap, so we look to buy because we buy low, sell high, right? So 50% level is dividing the line. and it's a great spot to buy if we're in an uptrend because the price is at a discount, but we still are most likely to go up, right? So I'll show you that with an example. The 50% retracement level is often called fair value or midpoint of the price leg. It's dividing them up again, like I said. So 50% is premium, 50% or below, above 50% is premium, below is discount. Right here, that chart we had from part 1, if you haven't watched part 1, go watch that because we talk about this chart. This high, this low, -2 to 2.5, we start consolidating and then continuing higher. And then this huge like here is a manipulation, which then was what the original consolidation or the original move that hit the key level, right? And then this same manipulation like taps into a CISD fair value gap because internal to external, right? And then again, it lines up with the same thing here. So if you're confused about this chart, what I just said, then go back to part 1 and you'll see the same chart but marked up differently. But I just added the standard because I thought it was really interesting. And then this looks confusing, but really, I'm just adding the premium and discount. Okay. So if we take the price leg from the low to the high, draw it out, we have a premium price where you look to sell into discount, and then vice versa. When price comes down to discount, tapping into key levels like this fair value gap, you want to buy below the 50% because anything down here is discount of the move if we're bullish, and then vice versa for shorts. So from the price leg, the higher high to the higher low, or I guess because this is a manipulation leg, so higher high to the lower low creates a breaker block, etc. But then we're in discount of this range, and you look to sell anything in discount or in premium, I guess in this case, because you want to sell when we're in premium prices, right? You want to sell high. So in this like here, the higher low to the lower low, okay? So again, the pullback, right? Again, go watch part 1. I talk about if you're trading the pullback, you want to trade it into premium and then get out. Or if you want to trade it with the trend, you want to sell when price is expensive or overvalued is where you want to sell it to then take it lower. So right here, we take the manipulation leg from the low to the high and we draw out our Fibonacci. So 0 to your 1 or 1 to 0, it doesn't really matter. If you're in a downtrend, you want your extensions lower. Okay, so you draw it on your manipulation leg, that swept liquidity, enabling price to continue to the draw. So we break the low, so you draw out your fib, and then this is where we can anticipate price to expand, right? Because we have the average price here, consolidation, and then we see that we sweep the high. Now there was an SMT here, so that means ES took this high, so we can confirm this is a protected high. Breaking this low, because this low is what swept liquidity, right? We broke structure by closing below it, so we can confirm this is the manipulation leg to continue lower to what? This standard deviation, because this is the average price and price is expanding an extreme amount. So then here we can look for either a reversal backed inside this range, or we could look for consolidation to continue lower. And this is what price did. So same exact schematic, but we just played it out. Tapped into -2 to 2.5 perfectly, consolidated, and then we end up actually getting a manipulation to then head higher, which I'll show you that here in a bit. And then here is the premium and discount. So this is the extreme range, okay? So consolidation, and then it displaces lower, creating the lower low. We draw from the high to the low. So anything up here, we look to sell if the overall downtrend is um, bearish and we have a clear draw, okay? So we're selling anything up here because this is premium and we sell when price is expensive and we buy when price is cheap. If we take this schematic, we have the higher high or the higher low on the downtrend to the lower low, okay? Draw that out. We're in discount, so price manipulated into a discount, right? Again, ES created that SMT. We draw our Fibonacci from the manipulation leg of the consolidation. Because again, we displace lower, consolidating, creating a new average price for price to get to an extreme, right? Just like we talked about. Rewind this a few times if you don't understand what I just said. But price gets an extreme uh, displacement move here, consolidates, creating a new average price. We draw our fib using the manipulation leg because this is the leg that sends price to make the new lower low. And we want to see where that comes, where that aligns with. And also we can frame this with draws on liquidity to the left, but we can use standard deviation as confluence, which is what we're doing here. This is the same exact example I just showed, but showing you premium and discount. We want to sell up here in discount ideally, right? So if this isn't, I would sell, me personally, I would sell somewhere here just because we have the CISD. So I would sell here because then the overall trend, this could still be in discount, but just for this move here, it's in discount up here. And it's confirmed by the manipulation leg, the SMT inside of a PD array, right? So here's another example. We have the manipulation leg, and the reason why is because we have the SMT, the CISD confirming this leg to be the manipulation because we have the SMT. So again, ES swept this low, sweeping liquidity to then displace higher. If we take the manipulation leg, because we consolidated and then manipulated, and then we close back above it, right? And then we have our -2 to 2.5. So that's where price is going to most likely expand with a clear draw on liquidity here. Okay. So it lines up. Now in this case, you would just target the draw, but you could have like TP1 or a break even at the -2 because it could obviously reverse, right? But then we have premium and discount because this is a new range leg. So price expands. So accumulation, manipulation via the SMT. We change in the state, CISD, from bearish to bullish, right? And this is a draw as well because it's what a swing high. Go watch part 1. I talk about draws. And this is low resistance liquidity, okay? Just like we talked about in draws and liquidity, where it's failure swings. So it creates that draw for price to rip through. Okay. So we take the low to the high of this leg and we buy anything in discount. Now, obviously, you can't pattern trade this. Like we have to frame higher time frame bias and narrative and stuff, but we take the low to the high. So anything under here, we look to buy. This CISD is an order block. That's a PD array. Price manipulates down into this order block. You set your buy limit here, standard deviation 2, and a clear draw on liquidity. Hopefully this made sense. If you have questions, join the Discord. You can at me in the general chat, and I'll try to help you there. But this is, again, pause this and study it if this doesn't make sense. And also, by the way, I don't know if you caught on to this, but this consolidation and then draw on liquidity here is literally this move here. So we sold here into -2 standard deviation, consolidated, manipulated. This is the same range to here. Okay, price move down, hits -2, consolidates, manipulates, then distributes higher. Do you see that? That move down here. So just thought I'll show you guys that how we can use standard deviation to project the potential reversal to the upside. Because in this case, we're playing the pullback into the continuation higher. Again, go watch part 1. I explain market structure. Weekly profiles are a conceptual framework that describes a typical pattern of price behavior over a trading week, Monday through Friday. They're part of an ICT methodology which emphasizes market structure, liquidity, time-based relationships. So again, time and then price. Weekly profiles help traders anticipate where the high and low of the week might form, where price might consolidate, or where reversals or expansions are likely to occur. Weekly profiles break down how price tends to behave on certain days, driven by institutional activity, liquidity hunting, and market sentiment. For example, institutional traders might push price to take out stop losses liquidity early in the week before establishing the week's trend. Okay, so manipulation on Monday, Tuesday into expansion Wednesday, Thursday, Friday, for an example. So there's 3 main types of weekly profiles. So I want you to take a screenshot of this here. These 3 are what you will study. Okay, the main 2 that occur are the expansion, the classic expansion, in the midweek reversal. The consolidation reversal week rarely happens. Okay, it doesn't happen too often, but the 2 main weekly profiles you want to be a part of are these 2 here. Okay, so the classic expansion week is a high or low of week is set early in the week, whether that, and it has to be a Monday or Tuesday, followed by expansion in the trend direction. A midweek reversal, the high or low of week forms midweek on a Wednesday, followed by a reversal. So what happens is price might rally Monday, Tuesday, form a high on Wednesday by taking out Tuesday's high or Monday's high liquidity, then reverses as smart money induces retail traders into the wrong direction. Consolidation reversal week. Thursday sets the high or low after early week consolidation, followed by a reversal or continuation on Friday. So price trades in a tight range Monday through Wednesday, then expands on Thursday, often taking liquidity and reversing or continues on Friday. So here's a schematic. I'll let you take a screenshot here of the classic expansion week. So again, this could be Monday or Tuesday, low or high of week. So you can see the candle schematic, what the candle will look like. So it'll open. Monday will usually tap a PDA right to the left. So maybe previous week low or what have you, inside of a fair value gap, order block, whatever. Expands higher. Tuesday, chopping, sweeping into a PDA, expansion. Wednesday, chop. This usually isn't the best day. Thursday will be a quick move and then it'll tend to just chill. Friday will induce everyone to be bearish, and then towards the end of day will expand higher again. So like 2 to 4 p.m. Right? So low of day on Friday would be like 10 a.m. for example. And then the candle in the time will look super bearish, but then again power hour will expand it higher. So can be kind of tricky, but as long as you have your drawn liquidity higher, Tuesday or Thursday haven't hit it yet, then we'd still be bullish. But if Thursday hits the drawn liquidity, then just be cautious to trade Friday. It's tricky. Here is the chart schematic. Monday low of week, Tuesday, Wednesday, Thursday, Friday. And again, Friday doesn't have to do this, by the way. Friday can expand. I'm just showing this version of it. So in this idea, Friday did sort of expand. So midweek reversal, this is one of my favorite weeks because it's very easy to spot out. Once after Wednesday closes, you can get a really nice Thursday expansion candle. a very clean setup, I guess, because you'll see expansion met with expansion. The reversal after sweeping Tuesday, you know here with a clear draw higher that this was a midweek reversal. So then you can anticipate Thursday and Friday to expand or Thursday expand with Friday consolidating. So again, take a screenshot if you need to. Here's the candle schematic. Consolidating Monday, Tuesday sweeps, Monday expands higher. So you would think, okay, this could be a Monday, Tuesday low of week with the expansion, and then Wednesday we'll say, nope, we're going to sweep that, then continue higher. And usually this happens on a news day, by the way. So if you're bullish for the week, but we have news on Wednesday, it'll most likely be a midweek reversal profile. If you have a clear draw higher and higher time frame order flow suggests. So that's why we study and use weekly profiles so that we stay on the right side of the market based on probabilities. Here is the chart. So Monday low of week, Tuesday starts to like expand higher. The reason why Tuesday is consolidating is because we have news this week actually. Wednesday manipulated lower, get that V shape. As soon as you see this V shape here, then we know like you could have the idea that we're going to continue higher with a clear draw. Take a screenshot if you need to. And here is a consolidation reversal week. Again, here's what the weekly candle will look like. This is typically not a good week. Normally this is a news week on Friday. Gosh, what's like NFP? So this is a tough week to trade. It's kind of hard to anticipate it in the moment, but just knowing that like okay, that was consolidation reversal week, right? Or if you hit the draw here and you notice Monday, Tuesday, Wednesday, Thursday are more consolidating, then you could anticipate maybe we get consolidation reversal week with news being the driver. Here's what that looks like. Chopping its way, just consolidating. Thursday being low of week, and then Friday just rips higher. So again, this one doesn't happen too often, to be honest with you. I would say the expansion or the midweek, but it's still something to keep in mind. Alrighty, so IPDA. Understanding this concept will keep you on the right side of the market and is very, very, very powerful. So let's get into it. Interbank price delivery algorithm. So it's not literally an algorithm used by banks, but rather a conceptual framework to explain how price movements are driven by institutional traders or smart money. The idea is that price doesn't move randomly, it follows a systematical pattern by large institutions to achieve specific goals like order pairing, hunting liquidity, or balancing price ranges. So IPDA focuses on two main drivers is liquidity and imbalances. So again, swing high is liquidity, imbalances are fair value gaps. So liquidity refers to the availability of buyers and sellers at specific price levels. Liquidity zones are areas where stop losses and pending orders are clustered. So buy side liquidity above a swing high, stop losses of short traders or buy orders from breakout traders. So this is how we generate the higher high, right? When we break above a high and price expands, there's buy stops, which are seller stop losses. So that's creating more buying. And then also there's buy orders. So market participants are buying the breakout, which then creates further shorts to buy back their price at a higher price, which can creates the expansion leg. Sell side liquidity below swing low stop losses are long trades or sell orders from breakout traders. So again, same concept. If you're longing and then price comes and takes out a low where your stop loss is at, or selling at a lower price, right? Which we don't want to sell low, we want to buy low and sell high. Balancing imbalances. So imbalances occur when price moves too quickly, leaving gaps or inefficiencies on the chart, such as a fair value gap. That is what an imbalance is, okay? So a SIBI is a sell side imbalance, and a BISI is a buy side imbalance, where price skips over a range due to aggressive buying or selling. So the expansion legs will create inefficient price. And then that's why we have external to internal, because if price shoots up, there's a bunch of orders that did not get filled. So price will have to come back, fill those orders, generating liquidity above us. Again, like stop losses and such, and breakout traders are ready, come back, and then we get breakthrough to continue. To sum it all up simply, it's is price rushing or is price consolidating? So if we know based off IPDA that price is in a bullish delivery phase, then we know that any bearish move is either a pullback or short-lived, aka manipulation. So until we hit the liquidity pool, we're gonna be bullish, right? That's pretty much IPDA right there. It's like if we have a clear draw on liquidity, then any down move is manipulation. Vice versa, if we have a clear draw on liquidity bearish, then any up move, even if we break structure to the upside, the overall structural, or not structural, but the overall bias is still bearish. Now, again, because we're day traders, we can trade the pullback, we can trade the long, but understand that with IPDA, it's still bearish. So we're trading the manipulation like higher, say if it's on the daily or the weekly, but to expect, or to size down really, and it's going to be a short-lived uptrend to then go lower. Understanding that, again, we'll go into this on part 3. So stay tuned to watch part 3, because we're going to go through the if-then logic. Again, price cannot reverse off consolidation. Understanding that with the clear draw higher, any down move is manipulation to continue higher, right? We're going to go through examples of that in part 3. So stay tuned, but hopefully you gain some knowledge and value here. We're going to move on to market profiles. So this is going to be in part 3. Let's head over to that. Thank you for watching, and I'll see you guys later.